I really do think that sales is like one of the number one traits in a founder. And that's because no matter what your company is, you're going to be selling because A, you're going to have customers, and B, you're going to need to fundraise. And at the end of the day, fundraising is a sales process.
Hey everyone, this is Prashant and I'll be your host of the VC10X podcast. And today we have Andrea Hippeau with us. Andrea is a partner at Lerer Hippeau, an early stage sector-agnostic venture capital firm based in New York City. In this episode, we talk about Andrea's story and how she started working in venture capital. How has Lerer Hippeau evolved over the past 10 years she's been at the firm? How has the New York startup ecosystem matured over the years? Why sales is one of the most important skills for startup founders. Breaking the stigma around bridge rounds. How to build and back successful consumer brands. Why is it a good idea to have a board in place from the early stages of a startup? Patterns she's seeing in the startup and VC landscape, and so much more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called VC10X, where I help VCs start and run their own podcast. While I was running VC10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Andrea, so good to have you on the VC10X podcast. How are you doing?
Thanks. Yeah, I'm great. Very happy to be here.
Yeah, it's a pleasure having you on the podcast. And to start things off, I know there's a very interesting story on how you started your journey in venture. So let's start with that.
Yeah, absolutely. So I started at Lerer Hippeau about 10 years ago. So it's been the majority of my career to date. I joined after I got my MBA at Columbia. And, I guess full disclosure, my dad is one of the founding managing partners. So certainly had a foot in the door in that regard, but never really sought out to work in venture, even though my dad did work in venture for the majority of my kind of childhood. But I barely even knew what venture was, to be honest. So I started my career in sales at a corporate sales job at Thomson Reuters, selling market data. Really pretty boring corporate sales job, but really important, I think, sales training, which I know is something that we're going to get to later when it comes to founders. But, I was cold calling, walking trading floors, having to kind of sell a second tier product in a market downturn. So it was a great experience. I loved the people I worked with, which is another, obviously super important thing about liking your job, but knew it was probably not what I wanted to do forever. So started thinking about applying to business school as a way to kind of make a career switch. And in the meantime, I got introduced to someone who was heading up a new, more like a family office / corporate VC called Advance Venture Partners. It's the Newhouse family, which owns Condé Nast, among a bunch of other traditional media brands. And they were starting a $400 million corporate development fund to do venture investing, M&A, and some other strategic partnerships. And I was the second employee. I was the SVP's assistant. I was also his associate. I was making coffee, writing memos, looking for startups. And it was just really exciting. And I realized there was this whole other part of the world where people loved their jobs, were super passionate about what they were building, had so much energy. And I knew when I went to business school, I wanted to stay in that world in some regard. So worked at two of our portfolio companies. A company now called Bark and Co, probably better known as BarkBox, and then the Dodo, which was a media company all around animals. So worked there, and then when I was graduating from business school, was trying to figure out what I wanted to do next. They had just raised the fourth fund at LH, and we're looking to bring on another associate. So started there, kind of thinking it would be a stopover to another operating role, but that was 10 years ago, and don't think I'm going anywhere. So yeah, and obviously, I think having my dad here was part of that, but also had to kind of get by on my own merit as well.
Absolutely. Yeah, totally. There's absolute merit there in you being there. And one interesting fact, like your father was actually the founding managing partner at Lerer Hippeau, right? And so when you came in, obviously you were his daughter, right? And like any dad would do, they would give them some gems of wisdom on how to succeed in this career, right? So what were those gems of wisdom that your father passed on to you?
Yeah, I mean, lots of gems from Eric. I don't think I necessarily am the only one that got them. He definitely passes them on throughout the team. I think, probably the most important thing that, he told me and tells everyone is that VC is a really long career. So, it's something that you have to be in for the long haul. You can't, just kind of decide you're going to do it. And, you really have to be committed because the feedback loop is so long, right? You invest in a pre-seed or a seed stage company. It could take 10 years to figure out if you made the right decision or not. So you really have to have strong conviction in your own ability to make decisions. Obviously that's something you learn over time, but and then you just have to be really okay with a long feedback cycle, and you need to be able to weather a bunch of different types of markets and just kind of stick with it. And so I think I know he tells that to everyone, and when we make new hires at Lerer Hippeau, that's really important to us. Obviously careers are long; they take many different turns. People want to try different things, and that's totally fine. But you really do need to be committed to venture being a lifelong career for you.
Totally, yes, absolutely. And now you've been here at Lerer Hippeau for about a decade now, and even more than that, right? So, how have you seen personally how the firm has evolved over these past 10 years that you've been here?
Yeah, we've evolved a lot. I think when we first started, we still were investing out of smaller funds. So I think, the makeup of the team has changed a lot, and as well as the way that we invest. So I think, maybe starting with the latter first, we used to write much smaller checks. So we used to write kind of 200K to 500K checks. We didn't lead rounds. Back then rounds were more like what we call a party round, where 5 or 6 firms would come in together, all putting kind of equal level checks. Especially in New York, because there just wasn't that much early stage capital at the time. That's kind of how rounds got done. Now seed investing is much more institutional. Typically you have a lead investor, who's going to set the terms, take the majority of the round, and then you bring in other investors alongside. So we have moved over the years into that lead position, where now we are writing kind of $1 to $3 million checks. We're leading rounds, we're setting the terms, and we're really taking ownership over the company, which is the most important thing. When you have a party round with a bunch of different investors all putting in smaller amounts, at the end of the day, when something goes sideways, no one's truly responsible for the company. So that's really important to us, is that, we have responsibility for the company at that stage, and then we kind of pass the baton on to the next investor, once they get to Series A. But for that period in the company's life, we're really responsible. And then we want to bring in partners alongside us that are going to share in that responsibility, both financially and strategically with the company. And then, kind of going back and talking about how the firm has changed, we've definitely grown the team over the years. I think that the caliber of people that we're bringing on is the highest it's ever been. I think our expectations for performance and performance management have also the bar has gone way, way up on that. And then, we're just a bigger team today. We're still fairly small for our AUM and number of companies. We're about 20 people total, and I think 8 investment professionals now. So, I think for, just under $1 billion AUM and 250 companies, still very lean, but have built out the team. And then we've also built out our platform team. So we have a team of people that really help our portfolio. And we now a 3-person platform team. We used to just have one person who was kind of like a jack of all trades trying to do everything. And we've taken more of a specialization approach to that, where we bring people on board who have real expertise in a couple of areas where we can really get deep with our companies. So we have an excellent head of people, operations and talent, and she's there to help our companies, obviously with hiring, but also more to teach them how to fish when it comes to creating an organization, putting the best practices in place, the types of hires you want to make, when you want to make them, things like that. And then we also have a fantastic marketing and communications person, very similar. Like, yes, she's going to make connections for you to journalists or whoever might be able to help, but she's there to show you from day one, how do you kind of put that engine in place to be able to be best in class in marketing and communications. And then we have our operating partner who's been there almost as long as I have. And, she really just makes sure that, we're getting our companies all the best resources. She puts on a lot of events and programming for them. And so I think that our offerings to our portfolio companies has also evolved with us. And I think, what we do for our companies today is, really best in class, and we're super proud of it.
Absolutely. I totally love it when like VCs have a strong platform team built out. And even after being pretty lean, a 20-member team, there's a significant chunk going over the platform as well. So commendable efforts there. And now let's talk about how you evaluate deals, since it's pretty early stage that Lerer Hippeau comes in. It's pre-seed or seed, not a lot of numbers to crunch at that point. So what are you really looking for at that point?
Yeah, we're really looking for people. We are betting on the horse, so to speak. Companies are going to change and pivot and iterate, thousands of times in the time that we're working with a company. And sometimes those are complete 180 pivots where a company was doing something, it didn't work, and they tried something totally different. And more often than not, it's, small to medium-sized pivots along the way that are going to kind of show that the company will look in a different form or shape, whether that's, the business model or the go-to-market or the brand, or there's just millions of ways for companies to change. So it's very hard at the stage that we invest to invest solely on a company's kind of, metrics, because a lot of times companies don't even have metrics, or if they do, they are not really indicative of what the metrics will look like in the future, or even kind of on, the mission vision of the company, because that also will change a lot. So we're looking for people that have true founder market fit, which means that they have a real right to win in whatever market they're building in. That can either come from professional or personal experience. And then, people that you can just tell are going to be excellent operators who have a very, very high standard, who, have shown in multiple ways, again, professionally, and this can also bleed into personally, that like they will run through walls. They won't stop until they get the result that they want. And then, there's just like a certain way that a founder carries themselves, the confidence that they have in themselves and their company. Obviously when you're backing like a second time founder, that really comes through, but there's first time founders too. That part is more of like a gut feel on someone. But yeah, for us, we're really backing the person. And then we look at things like the market size, make sure it's a big enough market that, also, what are the market dynamics? Who are the competitors? Are there a lot of incumbents? Are there regulatory issues in the market? There's lots of things to analyze. But at the end of the day, when we look back at our portfolio and the most successful companies we've had, it always comes down to the founder.
Great, that's amazing to learn. And since there are multiple partners at Lerer Hippeau, so how do deals get done there? Is it based on individual partner conviction, or do you sort of collaborate on deals and seek opinion from everyone? How does that work?
Yeah, so we are a consensus-based firm. Every VC does things slightly differently. Some, partners have kind of unilateral check writing ability where, if they get conviction on a deal, they don't really need to ask for others' opinion. Maybe they will, maybe they won't. Others have deals where there's only, processes where there's only a few partners that actually do deals, and then the rest of the team is there kind of for support. I think we kind of have a mix, which is that, everyone has a veto. So if anyone ever vetoed a deal on the team, it doesn't get done. And that's kind of, a very powerful but seldom used tool in our pocket. But so you do need like buy-in from the rest of the team. But the buy-in, I think, really comes in from the individual investor's conviction in something. And I think, going back to how we've evolved in our team, we bring on the best people. We try to foster them in a way that they can be their best, and then we trust their decision-making ability once they get to, kind of the partner level. And so that means, like, if I'm working on a deal, I'm going to be leading the process. I'm going to have the founder meet with other people on the team. I'm going to take the input from founders, the people on the team, and do work around it. Maybe there were some key questions that we need to answer, whatever it may be. But I'm going to lead the process, and at the end of the day, I'm going to be the one pounding the table to do the investment, and then I'm going to stand behind the investment once we've done it, support the founder, and be the one who's kind of responsible for that company. There are cases where maybe a few of us end up working on a deal together. We are extremely collaborative in that way. We're not competitive. It's not like a deal comes into me and I'm trying to hide it from everyone because I want to make sure I'm the only one that gets to it. And also, we are a generalist firm, which means we're investing in lots of different types of companies, and all partners on the team do everything. But there are certain things that some of us have more experience in. So definitely, like, for example, for myself, like, I've done more in highly regulated industries. So if someone had a company come in that was building in a highly regulated space, they might bring me in just for expertise or opinion, or maybe they'll kick the company to me from the very beginning. So there's no like, every deal is a little bit different, the shape of it and the way that you get there, but the end product is, one partner that has real conviction on a deal, that has buy-in from other team members.
Absolutely. Thanks for sharing that insight also on the front of which deals actually goes to which partner. So since you have expertise maybe more into regulated industry, so that deal would be more appropriate for a partner like yourself, right? Or maybe another deal which is dealing into some other category of startups can go to them. So I think that's a good way to distribute deals as well. Is that how it works? Yeah, am I
Yeah,
getting it correct?
more or less, I would say. It is collaborative in the way, like, I might have a first meeting, like, let's say it's a healthcare company, for example, and I know one of the managing partners, Graham Brown, it really knows a lot about healthcare. But I'll probably take a first meeting with the company just to make sure that it kind of passes just the standard bar that we have for companies. And then if I do think it's interesting, then I might pull Graham in for a second meeting and have him meet and get his opinion. And then if it seems like something that's really going to suit him better than me, maybe he will kind of take more of the lead on that deal, and I'll be there also as a support. Or it might be something that he gives his input on and then it kicks it back to me. So it's just different every time. But I think the punchline is we are collaborative, but you have to have your own conviction in deals to get them done.
Absolutely, totally agree. And let's now talk about the NYC startup ecosystem, right? Lerer Hippeau is like one of the leading VC names that's been there in the NYC ecosystem. So how have you seen the NYC ecosystem progress over the years, and how is it taking shape now?
Yeah, I should have mentioned that when we were talking about how the firm has evolved, because how New York has evolved is also how the firm has evolved, because New York has been our focus market and continues to be our focus market. So we've had to evolve with New York, and I think it's only been in great positive ways. New York 10 years ago or 12 years ago was very kind of media consumer centric. You mostly had either consumer companies starting here, or some company, media companies, or some kind of ad tech related companies, because that was really the industry here at the time. And we did a lot of those companies, and we had a lot of success there. But what you've seen happen over the years is many, many different types of founders starting companies in New York for lots of different reasons. And then a lot of the, FANG companies and larger tech companies opening offices here, some of them making New York their main kind of hub. And then talent comes out of there. So, for us, we're following talent pools and talent markets. And so where is their talent? And really you now have talent across the board in New York, where it used to be kind of siloed to a few different specific verticals. And I just think New York is like the best place to build a company, because unlike San Francisco, you're not going to be building in a vacuum of tech. There's New York has so many different types of people, so many different types of businesses here, and you're going to get feedback from kind of like the real world versus just from people that are also working in tech. I mean, that's kind of a mass maybe generalization of San Francisco, but I think that's kind of the main difference. And also, you're going to get companies are going to be able to hire talent that's pretty diverse as well, which is great. I think just the fact that there's so many new funds in New York, that so many of the multi-stage funds have either opened offices here or hired people in New York, just shows that New York is really, I would say, like the number 2 market when it comes to tech and VC after San Francisco.
Yeah, absolutely. And you rightly mentioned about Lerer Hippeau has actually led some of the best consumer brands that are now successful, right? So, do you have any insight on how to evaluate consumer brands? Because one thing I've gotten from VCs that I've interviewed is that in D2C consumer brands, it's binary. It either works out or it completely goes bust, right? So, how should they be looking at consumer brands?
Yeah, we've had a lot of success in consumer, but it is a challenging market today. And I think there's a few reasons for that, but mostly is around 2 things. One, and they're tied to one another. One is customer acquisition costs. It has become very, very expensive to do digital customer acquisition. And 10 years ago, it was really the beginning of Meta and the big platforms, and they were kind of giving away free money in a way because they were making it so easy and cheap to acquire customers that it felt like virality when it wasn't, because you were, and then when they flipped the switch and created a true marketplace and the market commanded a certain price, then that's when you saw a lot of consumer brands get into trouble. And then the second thing is, the lack of later stage capital for consumer companies, which comes from how beat up consumer brands have gotten in the public markets. And so, for us, like a company like Allbirds, for example, was, the most successful company we've ever had, huge multiple return for us, but for probably the last investors in, with how it performed in the public markets, was not the best investment for them. So then you see kind of a trickle down effect where you're like, okay, if you're a Series C investor, are you going to invest in a D2C company when maybe you're going to get 2x? Are there better places for you to deploy your capital? Probably. And so that has also created a real crunch in D2C, because there's just not that many late stage firms or multi-stage firms that do consumer. And I think you see announcements every single day about later stage VCs are just totally getting rid of their consumer investors. And so what I think that means is, it's not that there aren't interesting consumer companies. We are still investing in consumer, but the whole mentality around it has to be different. There has to be either a way for the company to be so efficient with capital, and that normally comes with some sort of go-to-market unlock, whether that is it started by an influencer and you don't need to do paid acquisition, or they're going to be distributed, they have some sort of distribution unlock with grocery or the big box chains or something like that, or there's a true tech differentiation in the product that's going to make it kind of a best-in-class product for consumers that they're going to be willing to spend on. And those companies are just a little bit harder to find. I do think that there are really great founders building in consumer right now with that mentality, and there's going to be, and I also think AI comes into play a lot in consumer. I think you're going to see bigger consumer AI companies in this first wave than you are B2B companies, because on the B2B side, there's a lot of issues with AI when it comes to compliance and security, and the sales cycles are a little bit longer. With consumer, you're going to get really fast consumer adoption of AI tools that are going to create kind of hockey stick growth. Whether that is sustainable, I think that's the longer term question. But I do think you're going to see really successful consumer AI companies in the next 5 years, and that hopefully will kind of change the mentality around consumer investing, because consumers spend trillions of dollars. It's not like, selling to consumers is a bad model. It's just, I think that some companies got hooked on the Facebook drug and weren't able to get off of it. And you had to see a lot of those companies die, unfortunately, for there to be a new way to do it. And I think that we're really at the beginning of that inning, this new inning of consumer, and there's going to be really amazing consumer companies to come.
Absolutely. Yeah, that's great insight there. It's going to be helpful for a lot of VCs who are looking at the space, and also founders on how they should be building their companies and not be completely dependent on Facebook for acquisition channels, and find alternative ways to build it efficiently, like as you said. uh, awesome. And now let's talk about, like you mentioned earlier in the conversation, of why sales is such an important skill in the VC career, but also more so in the founder world as well, when you're a founder. So how important is that skill, and how can a founder learn that and practice it in the initial days of the startup?
Yeah, it's so interesting. I would say up until 3 or 4 years ago, at least I personally didn't really think about sales as being an important thing for a founder to have. It was more around, technical skills, product building ability, and marketing, things like that. But I really do think that sales is like one of the number one traits in a founder. And that's because no matter what your company is, you're going to be selling, because A, you're going to have customers, and B, you're going to need to fundraise. And at the end of the day, fundraising is a sales process. And I think something that we've really learned with this last cycle is you can have a really amazing company, but if you can't fundraise, you're going to run out of money and your company's not going to exist. So being a good fundraiser is like almost as important as anything else, and sales is very much tied to that. So I think there's lots of ways that you can evaluate a founder sales skill. Obviously, what they've done in the past, have they had sales roles, things like that matter, but I think matter maybe less. But you really learn about it in the funding process, because pitching is selling, and when you are working with a company over 2 or 3 weeks or maybe a little bit more to get to that decision, they're going to be selling you in different ways. And I think more so than the meetings, which are important, and how they are in the meetings, it's also the follow-up, and what kind of follow-up are they sending you? Are they getting back to you right away? Are they sending you the materials that you asked for? Are they kind of going above and beyond? Are they reading between the lines of what you're asking? Because also in a sales process, when you're selling to a customer, follow-up is extremely important. And you can have a great sales calls with someone, but if you don't have good follow-up, you're going to lose that deal. And then I think, to your point, founder-led sales, you can kind of expect to be doing founder-led sales through your Series A. At the seed to Series A, it's typically founder-led. Maybe you hire a salesperson to kind of help you with some of the administrative work, but you are the one that's going to be selling. And so that's incredibly important. But I think that also goes back to what we were talking about earlier about founder market fit, and that a founder really understands the market that they're selling into and the buyer, because buyers can sniff out, no matter what market you're in. If you don't know what you're talking about, they're not going to take you seriously. And so I think the founder has to have an innate understanding of the buyer and the buyer's pain points, and the ways that they're either going to save them money or make them money. Because at the end of the day, that's what it comes down to. And if you don't really understand the market that you're in, you're not going to be able to help with those things. But yeah, I think, you can learn a lot about a founder's sales abilities through the pitching process. And then obviously there's lots of ways to support a founder, and we work with sales coaches, and there's, lots of different ways to help them hire the right people. But they have to have it. They have to bring it to the table themselves. We can't go out there and sell for them. And we definitely, can't help them we will help them a lot with their fundraising, but we can't be in the room when they're pitching their next investor. And so it's really, really pertinent that a founder has real sales skills. Or if you're a more technical founder, that's great too. I mean, obviously, technical skills are the harder thing to hire for or develop yourself. So but you have to be personable, you have to be curious, you have to be willing to learn about sales. I'm working with a founder right now who's highly technical, doesn't really have any sales experience, and he's just like a sponge, trying to learn as much as possible so that he can be successful at it. Because even if you're a technical founder, if you're a sole founder, or if you're the CEO, you're going to be the one who's doing the selling.
Absolutely. Yeah, that's great insight there. And now let's talk about sourcing and winning deals, right? And now that Lerer Hippeau is actually a brand in itself, you must be getting a lot of inbound deal flow as well. But let's say for an earlier stage, a newer VC or maybe an emerging manager, when they have to like build out that brand and they don't have that brand in place, right? What would be the best way for them to find high quality deals and then win them?
Yeah. Again, just back to sales as VCs, like obviously people are pitching to us, but we also have to be selling both to founders, to, the best founders, to get them to let us invest or want to work with us. And then also we have LPs as well. So I think especially as like a solo GP or an emerging manager, you're going to be doing a lot of selling of yourself. And I think you need to figure out what are your strengths and where can you add value from day one. And I think more importantly than necessarily getting into a deal in the beginning, although obviously that's important, is helping founders and creating value for them where they're going to go to the next founder. You really want to work with this person. They did XYZ for me. They followed up. They hustled for me. Like that's what's going to make an impact with founders. So I think at the beginning, you just have to find founders kind of wherever you can. I mean, obviously, no matter what city you're in, there's all sorts of tech events, places to meet founders, your own network, whatever that may be, just start pounding the pavement on it. And then once you do start meeting founders, just figuring out what's unique about yourself that you can bring to the table and help them with. So maybe that's you have some really great business development deals, connections that you can help them with, make introductions for them. Maybe it's that you know a lot of technical folks and you could help them with their first kind of technical hire. Maybe it's that you have sales experience yourself and you could help them think about their sales playbook and how to build that out. Just tons of different ways. Fundraising, like if you know a lot of other VCs and you can help them with their round, that's also, super important. So just thinking about the ways that you can be unique, can't really be generic because there's other investors out there. You don't want to just go out and say you can help them with everything because that's probably not true. So just figure out what are the one or two things that I could really hone in on. Like I remember an emerging manager I worked with a long time ago, and now they have a fund and they've been very successful, but they were basically the company's interim CFO. They came in and helped the company with their financials, their bookkeeping, building out their model, thinking about revenue builds and things like that for probably a year or two, really. And I mean, that it added so much value to the company. And I think, obviously they wanted to work with that company. And then they also referred them to other founders that were looking for similar support.
Absolutely, yeah. Finding your edge early on is extremely important, and then marketing it to your potential founders and deals you want to do, right? So, since you're a generalist VC, you get a bird's eye view of all the different sectors, right? So, what are the most exciting sectors to you right now, and what kind of startups or deals would you like to see more of?
Yeah, there's so many exciting things happening right now. I mean, back to AI. There's obviously a ton of hype around AI, and we don't totally buy into it. I think there's a lot of AI applications that are not that defensible. And I also think the fact that there's probably thousands of AI startups right now is kind of false because there's not that much talent that are true AI experts. Like there's probably 100 people who really are deep AI experts. So I just don't believe that all those companies are going to make it. But I think the way that AI can be applied companies is really interesting. And there's just a lot of businesses that have offline processes, these more kind of archaic industries where literally you're faxing in some cases, but scanning and filling out PDFs, or reviewing a person is manually reviewing a document, kind of looking for the same criteria over and over and over. Like these are places where vertical applications of AI that can be really interesting, and I think unlock a lot of value in these verticals that's been kind of just hard to unlock because people don't necessarily want to adopt another software platform. It's hard to get, an accountant, for example, at a small or medium-sized business to get off of QuickBooks and start using your accounting software as an example. But if you can work within that person's workflow and create some technology that is going to seamlessly, create reports for them or do data entry or data pull or data analysis without having to kind of break up their day-to-day, that I think is where there's going to be a lot of incremental value that's captured. And I think AI is really the first tech shift that has allowed that to happen. Before you had to adopt a whole new kind of siloed platform. Now you don't even have to leave what you're doing. And like thinking about, really big ideas about like the future of the internet. Like, will we be going to web browsers in the future? Probably not. I mean, and looking for companies that have really, really big ideas. And I think that, before some of these things were real moonshots, and they're still moonshots, but AI maybe brings down the bar a little bit on how hard it is to execute on some of this stuff.
Absolutely, totally agree on that. And I heard you say something interesting in a different podcast, which was something along the lines of that actually having a board in the early days of a startup is actually helpful for them. And I know that a lot of founders don't want that, especially in the earlier rounds, pre-seed and seed, to take on a board member right then. So, can you share more on that?
Absolutely. And, I think board is just kind of a word to describe getting your major investors together on a regular basis. And I think what it does, it just creates a level of accountability, and then also an opportunity to kind of lift your head out of the day to day. Because as a founder, your day to day is nuts. I mean, you have thousands of things to do in a single day. There aren't enough hours. Your head's down building, fighting fires constantly, hiring people, firing people, thinking about that next strategic level. So, like, there's just so much going on. And what happens is, if you don't take the time to have kind of a retrospective moment and, create, this is maybe a half day's work to put together a board deck or an investor presentation. And it's really much more for the founder than it is for the board itself. And it's that moment to think about what's been going right, what's been going wrong, have we gotten off track, are we still executing on the big vision that we set out for? Has that vision changed? Are there reasons why it's not going to work the way we thought it was going to work? And if so, like, how are we going to change it? Is this still an exciting opportunity? I mean, I think sometimes you start building a company with a certain set of expectations, and then, those expectations get chiseled away at, maybe there's a regulatory hurdle you weren't expecting. Maybe, there's an extra step in the sales process that you weren't expecting. Maybe a new competitor or a competitor you didn't know about, pops up and is kind of eating your lunch. So these things happen, but if you never take the time to really think about it, and you're just going to get bogged down in the day to day, and the company can kind of go off course. So it's not that you're going to get amazing insights from your board or your investors. I mean, hopefully you leave the meeting with a few things that they've said that make an impact. But board members and investors are not any smarter than founders, except that we see a lot of different companies and patterns across them, and can help you be like, okay, I have another portfolio company that went through the same thing. Let me help you think it through. Let me connect you to that founder. Like, those sort of things. Those are helpful for sure. But it's really about the founder taking the time. And without the forcing mechanism of a board meeting or an investor meeting, founders just tend not to do it because they're just too busy. And so that's really, I think, at the pre-seed and the seed, that's where the value of having a board or some, set of your investors that you're kind of doing these regular catch-ups with.
Absolutely, yeah. You mentioned the patterns that VCs get to see across different companies. So, what are the patterns that you're seeing right now, especially in a market that's not as moving as quickly as it probably used to a couple of years back, right? The funding isn't moving as smoothly. So, what patterns are you seeing there, and what are the graduation rates that you're seeing at maybe from seed to Series A? Has that shrunk a lot from what you were seeing maybe 2 years back? So, share more on what you're seeing there.
Yeah. Yeah. The funding environment is still challenging. I think it's gotten a little bit easier at the seed and a little bit easier at the Series A. But it's still very challenging at the Series B and kind of beyond. So what we're seeing is that there's no more of like a linear path from seed to Series A. It used to be you raised your seed round, you validated a few things, you got a little bit of traction, and then you were ready to raise your Series A. That doesn't really happen anymore. And we really want every company to think about needing to raise a bridge between their seed and their Series A, which really means that you need to set yourself up at this pre-seed or seed to have the flexibility to do that. And that typically comes in the way of valuation, because if you raise your seed round at 15 or above valuation, that implies a certain valuation for your next round, and then you're kind of losing the flexibility to raise a bridge. And it also means the type of investors you want in your seed round are potentially a little different. You might want investors that have deeper pockets and are going to be able to support you in what is probably going to be an inside led or totally inside extension round. But it also takes away some of the stigma of a bridge. I don't think a bridge is necessary. Bridge used to be, oh no, I'm in trouble, a bailout. Now it's much more around, just proving out those metrics to get to Series A. It doesn't mean that the company is going wrong. You could definitely be growing and still need a bridge. You could be executing well and still need a bridge. But you need a lot more validation or even true product market fit to raise a Series A now. And so that takes a lot of work and a lot of time. And so, $1 million ARR used to be kind of the gold standard for Series A. If you got to $1 million ARR or whatever the equivalent is for your business model, then you were going to be able to raise your Series A no matter what. I would say that number is potentially more like $3 to $5 million ARR. But more than that, it's about momentum and that you have momentum in the business and that you're able to say to a Series A investor, hey, look at my pipeline or look at my wait list of customers that I have. I just need funding to be able to hire or buy inventory or whatever it may be to execute on this pipeline. That's what's going to get a Series A investor excited, not, oh, well, we tried this, we tried that, we're still working on it. You're not going to get a Series A investor to come in for that. That's when you're going to have to either raise a bridge or come back to your insiders for additional capital.
Thanks so much for sharing those insights. I think it's going to be helpful for founders to get a sense of how things are shaping up in the venture ecosystem. And now let's quickly do the rapid fire round, wherein I'll ask you 5 quick questions about the investing that you're doing at Lerer Hippeau, and you have to give 5 quick answers. Sounds good?
Good.
Great. So the first one goes, what are the sectors and regions you invest in?
Everything. That's the quick answer. But yeah, we invest in all different models, verticals, sectors, business models. Very, very little that we don't invest in.
Great. And what's the typical stage you invest in?
Pre-seed and seed.
What's the typical check size you put in?
1 to 3 million.
Where can founders apply for funding in case there's a direct way?
You can reach out to me, Andrea at lererhippeau.com.
That's great. Where can our listeners follow you?
I guess X is the best. I'm not super public, but I'm at Andrea Hippeau on X. So I post there not very often, but probably the best place to find me.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time, Andrea. And I wish you happy investing.
Thank you, Prashant. Nice to meet you.
Thank you.